Welcome back to the Seattle Multifamily Podcast. My name is Jerrid Anderson. I'm an apartment broker in Seattle at Kidder Matthews. Today, I'm sitting down with 3 investors who have recently closed on a property in 2024. We're going to go over each deal, what the challenges and successes were, and what ultimately led them to invest in the current market. Today, I'd like to welcome Will Heaton, Lex Wieneke, and Ben Maritz to the podcast. So our focus today being, I guess taking a step back, Trinity invests in all shapes and sizes of real estate.
We do. Yeah. So we're all food groups. We've got a tree farm. We bought a hotel in Hawaii on the beach, and we've got, multifamily. We've got tilt-up industrial warehouse. We kind of do it all. Okay.
So our focus today being Seattle apartments.
Yep.
Since you have this diverse portfolio, what attracts you to Seattle apartments specifically?
Yeah, I think we've always been attracted to Seattle apartments, and it's changed in terms of what we've been looking for and focused on over time. But currently, what attracts us to Seattle multifamily is really kind of the supply-demand imbalance that's forthcoming. We're seeing a really tapering in the supply over the next couple of years, with no new supply coming online, with kind of the equation for development out of whack, and so we see a forthcoming rent growth potential as well as kind of superior returns to what we're seeing in other asset classes on a risk-adjusted return basis, and then also relative to, say, the east side, where you get this kind of east side premium, and people pay up for it. But for that, the returns are lower, and I don't think the risk is different. It's similar. So for us and our clients, which for us, it's capital preservation as well as creation. Seattle's a really good place to be.
So Seattle has always been really good to us. You started out really just buying single family houses back in 2005, 2006 in core Seattle, and making them rentals. And then over time we, bought them, exchanged them for duplexes, traded them for, 5-unit deals, and kind of built up over the last almost 20 years now. And, I've tried buying stuff where I thought, hey, a whole bunch of units in a less desirable area is, the numbers don't end up really being as exciting as they are when you've got to, factor in crazy amounts of money for turns. So we spent a bunch of time building our portfolio through probably 2015 to 2019 in core Seattle. And then the pricing got really aggressive. And then we moved down into South King County and really liked the prices there. And as we've kind of seen the sentiment in core Seattle shift a little bit, some people have ran away from it. We're back there. We think there's some great opportunities in Seattle.
We love Seattle. I mean, it's where I live, and it's a wonderful and vibrant city, and it's one that draws a lot of people. We have tremendous demand in Seattle, and I think we've especially seen that in recent years, where we've also had tremendous growth in supply. In the first 2 quarters of this year, 2024, we saw over 5,500 apartments get delivered, almost all of them which were absorbed. So it's a huge
This is in the city of Seattle?
In the city of Seattle.
Wow.
And so we're growing around 2% per year, which is one of the fastest growing growth rates of any city in the country. It's higher than many of the Sunbelt cities that people talk about as being high growth.
Yeah, interesting.
So we have a lot of demand for housing. We also have a lot of wealth, which creates a lot of investment and opportunities. We don't have enough housing at the segment that we're trying to target. So for us, it's a very much a target-rich environment.
So shifting into a specific deal in Seattle that you've worked on recently, size, location, age, what are the...
Sure. Yeah. So recently we closed with you. Thank you, by the way. Outstanding. A couple months ago, we closed on a deal called Uptown Queen Anne. Obviously, it's named twice for its location, so it's in Uptown or Lower Queen Anne. So the building or the property has 60 units, about 2,000 feet of commercial, and big parking garage. It's 501 construction.
So Seattle deal, you'd mentioned Dexter House.
Yep.
So let's talk about size, vintage, just like overall makeup of what it is.
Yeah. So that's I think a 68 construction deal, which is what we've spent a lot of time in. That 60s, 70s, 80s product has kind of been our bread and butter. It's a 29 unit building. We're going to add a unit, so it'll be 30 when we're done.
Nice.
Unique deal where the prior owner owned it for 40 years.
Oh, wow.
had a fire in the entryway. So City of Seattle deemed the building unsafe to occupy, and the ownership had to get everybody out of the building.
Oh, wow. So it's vacant.
It was vacant.
Okay.
And she had a lot of challenges with having it be a vacant building because
Oh, yeah.
squatters had moved in and they stole most of the wiring, all the home runs. I mean, they were in there for days on end, just stripping the electrical out of the building, stripped the elevator, operating systems, all the wiring out of the elevator system.
Wow.
Sure. Western Air is a great building. It's pretty typical of what we try to do. It's about 30 units. It's out in West Seattle. It's a kind of classic 1960s cinder block construction building, single loaded corridors. So it's got the exterior walkways, and the units are all smaller one bedrooms. Okay. So we really like product types that is small for its size. Okay. So these are about 440 square feet, one bedroom apartments, which is right in our wheelhouse because we're able to rent them at that affordable rental rate.
What attracted you to it in the first place?
When it came out, the overall location.
Yeah.
It's, being there in Queen Anne, right above the Westlake, the views out of the units were, pretty awesome. And
Nice.
You wouldn't build a building on that lot today the way they built it.
Okay.
With it, spreading across the, just almost every unit's just got.
Oh yeah, it's single loaded corridors, all lake facing. So every unit's got a view,
lake
cut
and
into
city.
a hill.
Yep.
Yeah.
So it's got 30 plus parking
Oh
stalls.
wow, that's really uncommon.
So really cool. Just the views are unbelievable. Lake Union, you can see Bellevue, you can see downtown Seattle, Space Needle, Gasworks, kind of curves around.
Wow,
So,
panoramic.
A really awesome location, really cool view, big units.
Yeah.
They're 1,000 to 1,400 square foot units.
Wow.
The one beds which we're adding dens to, are 750, 800.
Still really large for
Good
this
size,
market.
good size units.
Yep.
And the starting price point, while it was unpriced, we saw, hey, fire, vacant, squatters, and we knew that there was going to be a lot of people who didn't know how to dissect that and make a quick decision and understand how to get into it. So, we spent the time working on due diligence and did all that prior to writing our offer.
First off, we really like the vintage. 1990 to 2010 is an attractive era of product to us. You tend to get less deferred maintenance, because of newer systems.
Yep.
Things tend to not be, they're sort of at the end of usable life, but they can be repaired, not replaced. Bigger unit sizes on average than newer development, and really livable layouts. You got washer dryers in the units. You've got sprinklers. That's a big deal these days with insurance. Yep. And tend to have higher parking ratios. And for Uptown, it really ticked all those boxes. Okay. Added that it had views and a great location there in Uptown, proximate to Climate Pledge, in a market that we think is going through a renaissance. Took a step back in the pandemic, but it's really starting to improve now that we've got the Kraken back, and Climate Pledge is driving something like 250 events a year, which is driving a lot of traffic and vibrancy. In 2035, we've got a light rail station coming. So we're long-term holders and big believers in that marketplace.
Nice. So how many roughly properties do you look at or underwrite on a quarterly basis? Any rough?
Yeah, I'd say on a quarterly basis, we probably look at, should I get 2,000 emails, maybe more of deals, even in our marketplace. But in terms of truly underwriting, I bet every quarter we underwrite 30 deals. Okay. And that's, we think about it in terms of 5-1-5. Okay. 5 seconds, 1 minute, 5 hours, 1 day.
5-1-5-1.
Yeah.
All right.
5-1-5-1. Yeah. So I'd say that the ones that get to 1 day, it's probably 10 to 12 a quarter.
Okay.
We try to underwrite pretty much anything that comes to market in our kind of class of affordability. Okay. So we're probably seeing 1 or 2 deals a week, and put everything through a screen.
So 20 to 30 a quarter.
Sure. Okay. Yeah. 20 to 30 a quarter, and some of them just at a high level and some of them more detailed. Okay. We had a small fund that we raised that we were investing out of because we wanted to be opportunistic. Over the past couple of years, we've seen many sellers not sell, and we needed to be there for the sellers that needed to, so we could move quickly. Yep. This was one of those cases. The seller had an exchange that they needed to close on, and so they needed to find a buyer. They had been on the market for a while. I think they had something where it fell through due to some issues in the building, which we can talk about later.
Yep.
But we were able to be there quickly. We were able to close in cash at a price that worked for us.
Okay.
Really run at hard and look at probably quarter basis, 5 or 6.
Okay. And do you write offers on all those?
No,
Okay.
no. I mean, when I write an offer, I'm looking to buy the building,
Okay.
right? So we're not just spitting up offers out on everything. It's like we've kind of vetted the broker and the situation and feel like, hey, is this seller willing to meet the market? Do we think this is going to transact? And, do we have a chance to get it? And, on a deal like this, we know that, our knowledge with construction, our ability to, get those numbers done in-house. And, we have our whole, new construction townhome side. So we're real familiar with the permitting process in the city of Seattle. And, we felt that it kind of gave us a leg up to put that time in to really, write an offer where we could get, non-contingent and put our offer at the top of the stack.
Okay. So I'm guessing they got multiple offers.
Yep.
You guys wrote yours. A variety of ways to approach it. Will be the higher price with tons of contingency. Will be the lower, simple, high risk for you, but low risk for the seller. How did you guys decide how to write your offer?
We, didn't get a lot of feedback from the broker on the deal. We got some. It was an interesting situation there, but I just went for certainty of close and felt like that the broker had seen. I think we went to the site 3 times before the offer review date.
Yeah,
brought some subs through, brought my construction team through, and got a fair amount of hard bids on it. And then we have stuff that we've pre-negotiated costs of a lot of the items.
Nice.
With our subs, and we've got 7 or 8 buildings under rehab right now. So we just know current costs. There were some outliers there that we needed some clarity on. Got the clarity.
Yep.
And had a solid renovation budget. Did the rent study, and we're able to come in with a quick close, non-contingent.
So breaking the deal into a few stages, we're writing a purchase and sale agreement. It's been out on the market for quite some time, I think. And what are some, strategies that you use to negotiate a good deal at the start?
I think that this particular deal timing was really important to the seller because of their exchange. I think they had maybe 4 weeks by the time it came back to us. The seller decided not to sell, and then they decided that they had to, and so they had limited options.
Gotcha.
Our price negotiations were fairly straightforward. The seller was kind of transparent about what price they needed, and we were able to get pretty close to that and still hit the return hurdles that we needed.
Gotcha.
The most important thing is I think we closed in like 3.5 weeks after we went mutual on our purchase and sale agreement.
It was interesting. It was one of the more straight over tackle deals. From that standpoint. And that really came down to the seller just wanting to avoid cost.
Yeah. True.
Yeah. I don't know if you recall, but ultimately we had 2 back and forths on the LOI. We offered, they countered, we countered their counter, and we settled at our price. And then we went to PSA. All the terms were pretty much pre-negotiated. They served up a CEBA agreement, and fortunately for us, we've done 15 or 20 deals on CEBA. So we're pretty comfortable. There's like one little thing you got to work through, but we know the workaround, and so we signed it the next day. Yeah,
and that's a commercial brokers agreement, which is a form agreement. Not Kidder's agreement. Someone asked me that recently because we have a little emblem on there.
Top right.
Everyone in the industry, we've done, I think as large as our biggest was a $61 million deal on that agreement with a couple changes all the way down to, 4 or 5 units.
Yeah, I would say this is our
pretty balanced.
One of probably the biggest CEBA transaction we've done.
Okay.
But
pretty straightforward.
Frankly, it's an easy form to work with that we don't mind doing. So,
and then I would say you guys are probably better at pre-due diligence than anyone else that I've worked with. So by the time we're walking through the building, you already know it pretty well. Is there anything that you'd recommend or that you learned through due diligence process from this one compared to other purchases you've done? Or is it also, this is why you're buying these boring 20-year-old buildings?
I know.
There's no surprises.
They're not supposed to be surprises. There usually is something, right? There's something that shows up. And there was in this one too, just like all the others. But I think for us, our diligence it's really easy to outsource it.
Yeah.
It's really easy to hire people to do it for you. But I don't think that's the same thing as doing it yourself.
Yeah.
And where that showed up in this deal was, we do a unit by unit walkthrough. No matter how many units are in the building, we have somebody from our team looking at every unit. In this case, there was one vacant unit that I walked through and saw some staining on the concrete below a column. And I was like, doesn't look very good. What is that?
Yeah.
And we called in an expert to take a look at it, and they're like, nah, it doesn't look good.
Yeah.
And it ended up snowballing into a huge issue that ultimately we were negotiating like 10 days before closing because it contributed to a big holdback.
Yep.
Which fortunately the seller worked with us on, and they kind of recognized, look, this is our issue if you don't close.
Yeah.
And so we were able to come to terms on that. But had I not been touring it myself or one of our team members, we might have missed that.
Yeah.
Because you got to look at every unit.
Yeah.
And that's hard to do in 250 units.
Do you know when I learned that, by the way?
Yeah, please.
The only building we ever sold for you guys.
Oh, yeah.
Ever. Arbor
Hills.
Arbor Hills.
Yeah, Arbor Hills.
Unit by unit inspection.
Des
I'm there, I don't know, for the 89th or 90th unit.
Yeah.
And of course, lo and behold, that's the one that's like been flooded into non-existence.
Wasn't that the one that also had a server farm where they were farming Bitcoin?
In that building, yeah.
Yeah.
A lot of stuff going on. But I realized, and this was early in my career, I'm like, can I just leave now? And they're like, no, you got to stay till the bitter end.
Yep.
You got to look in every unit. You just don't know what you're going to find.
The biggest issue with that property was it hadn't really been invested in for a long time. And so there was a lot of maintenance debt. There was a lot of apartments that were below market, even for how we think about the market rents.
Yeah.
The biggest single issue was all of the electrical panels were old and no longer insurable.
And I believe they were in a kind of odd location.
And they were in an illegal location. Yeah. The panel was right above the sink in the kitchen. You can't have an electrical panel so close to a plumbing fixture. So we had to move. We knew we would have to both swap the panels out and physically move them to a different location.
Gotcha.
Within the property. But we were planning to renovate the kitchens anyway, so that was just part of the scope that we brought to the table.
So we get through the due diligence and we're running through to closing.
Yeah.
So financing on the deal, it's a tough market.
Yep.
Was that an issue for you guys?
Our focus tends to be kind of 50% leverage.
Okay.
So typically it's not a big deal for us to go through it. And we are focused on non-recourse, which has its own set of lenders and challenges. But this one was unique because the value relative to the NOI was kind of poor. So it was a low cap rate, and so getting to proceeds was actually more challenging than we expected. Ultimately, we were able to get there, but we closed a loan that was essentially 45% LTV.
Wow.
And what was challenging about it wasn't kind of the normal things with lenders, underwriting us and everything else. It was really underwriting the transaction. They wanted to take we'll call it underperformance relative to our expectations, but performance that was in place relative to value that was pretty weak, and then apply really heavy conservative assumptions like 6% vacancy and 2% concessions and 1% bad credit. So you get to 9% loss off the top, and it's really hard to get to your proceeds. So we targeted 50%. We ended up coming in at 45.
Wow.
In an asset that were 30% below replacement costs, 25% below peak.
Yeah.
It feels so straight over tackle.
Yeah.
And we did it with a relationship lender.
Because of the structure of what we were working with a fund and with some investors, we were able to close in cash and then come back and add a loan after we closed.
Okay. And so you're closing it and immediately going in refinancing?
Yeah, we did. I mean, we would have probably done better if we had waited, but of course, that's in hindsight.
Yeah.
So we ended up closing more or less right after we closing on the financing right after we closed on the property.
Okay.
That was during the period where rates were still going up.
Yeah.
So we felt like we had to do that quickly to not have rates melt up on us.
Yeah.
Faster.
Gotcha. So now you've gotten to closing. Any other hurdles or nuances that made it difficult?
Probably the biggest hurdle was insurance.
Okay. Yeah. How do you insure that building?
Exactly. So that was the toughest part. And we had a deal recently where it was pretty rough and there were tenants in there.
Yeah.
And the issue was, well, you need to fix it and it's occupied.
Yeah.
Right. It was like, okay, well, yeah. How else are we going to fix it?
Yeah.
The insurance company jacked our rate up on that.
Yeah.
And then this one, they said, well, we don't want to insure it because it's vacant.
Because vacant.
And it's like, okay, well, at what point, like, what's the perfect mix,
Yeah.
right? It's, there's somehow we've got to get these properties back in shape and back online.
Yeah.
The insurance companies just don't want to touch them. So
do you have traditional like
we have,
insurance that
we
I have
have
on
our
my home,
builder's
or
risk
builder's
policy
risk?
that we have for, our construction company.
Okay.
So we obviously added on that. And then we got a general liability policy on the building.
Okay.
And it wasn't cheap.
No, they
at
aren't.
all, right?
But smart to get, right? Just to protect
Absolutely.
yourself. You have
Yeah.
no idea
And-
who else is going to break in there. And
And our insurance isn't. It's not like we've got the Cadillac insurance policy on this thing.
Yeah.
I mean, we paid for a Cadillac and we got the Kia here. So we're until we get this property back into occupiable condition
Yeah.
and off of the city of Seattle's vacant hazardous building list.
yeah,
We're kind of stuck on this,
high
pretty
risk.
rough, high risk policy.
Interesting. Okay.
Once we got into the building after we closed, we realized that there was a little bit more work to do than we had anticipated.
Okay.
In particular, one of the bathtub drains was not attached to the drain. So there was a bathtub that was just draining into the foundation of the building
Oh, wow.
for probably on the order of 20 or 30 or 40 years,
Oh, gross.
creating a crawl space, basically excavating out.
That didn't exist
It's
before.
a slab on grade construction.
Oh, man.
But now there was a crawl space under a pretty good, like 3-foot space that had just been excavated by 30 or 40 years of somebody
Water
bathing.
erosion.
Right.
How'd you find that? Like, could you have found that during an inspection, or is that just one of those weird things?
I think in retrospect, we did notice corrosion in some of the electrical fixtures around the ground floor in that part of the building. We attributed that just to moisture and lack of ventilation in the apartments. But looking back on it now, that was clearly because of all the water that was underneath the building coming up through the slab.
But could you even, as part of an inspection, found that? Like, I guess what led to you finding that? Because no one found it for 30 years.
Basically, when we were pulling up one of the floors as part of our renovation, we noticed that there was a hatch that was cut into the concrete. And that is what caused us to ask, what is this metal plate doing here? Opening it up. Hey, why is there this space under the building? We thought it was
Gotcha.
slab on grade.
So it looks like someone knew about it at some point in time.
At some point, yeah. And it could have been before the seller as well.
Interesting.
In the end, it wasn't a huge financial impact to us.
Yeah.
We just had to go in and build basically little foundation walls to support the building.
Oh, wow.
And then obviously repair that particular drain.
Okay. So now we're closed. About when did you close?
It's like 45 days, almost to the day.
About October of last year, so about 9 months ago.
Okay.
4 months.
Okay.
Yeah.
So I'm guessing we
3
don't
months.
have any units online yet.
Yeah. No. The building was stripped of its copper and
So you've closed. If you recall, what were the rents that were in place? What did you think the market rents should be? And then how are you doing with achieving those today?
So the rents that were in place were a bit all over the map. It was it wasn't self-managed, but there was sort of not a fully professional manager there. Their rents range from $800 or $900 up to maybe $1,200.
Okay, so pretty big range.
Yeah, pretty big range.
I like to see when I'm looking at an investment that has the same unit type.
Right.
Why is there a $300 difference?
That's right.
Yeah.
Yeah. And we thought that the renovated one bedrooms there would rent for about $1,445 to $1,495.
Okay.
And that's right around that 50 to 60% of area median income rents. That's kind of where we want to be to provide the affordability that we need for the residents and still get the returns for our investors.
Yep.
Between October and now, we've renovated almost all of the apartments.
Oh, wow.
I think we've got 4 or 5 left to go with long-term residents that were in there.
Okay.
And as part of our plan, we try to treat the residents well. We always give them the opportunity to choose to either stay in their apartment and have their rent come up to close to market. We give them a little bit of a discount.
Okay.
Or we say you can move into a new apartment that's fully renovated and pay this new rent. That new rent is the market rent. We do also give them a little bit of a discount if they stay, as a way of thanking them for having been there for so long.
Gotcha.
And I think that basically all of the residents, a few of them chose to leave, but most of them chose to stay and stay in either in their current apartment and without the renovation, or to move to a newly renovated apartment.
Okay. So business plan was start by just moving rents to market.
Yeah, business plan was pretty server tackle, to be honest. Is buy it at a reasonable basis, solve through mark to markets on rents to a pretty good yield, kind of in the mid upper fives.
So mark to markets for
the residential rents. Yeah. So trading out existing rental rates that were at $291 a foot on average to our underwriting is about $330. So we had about, what was it, like 14% loss to lease in the rent roll that we thought we could gain.
And loss to lease is just what you think market is, where the existing is. What's that percent of
it's
loss
the differential
to the leased rent? Okay. Yeah. And then now, have you had any vacancy?
Yeah. Okay. Yeah, we've had one. Well, frankly, we've had, I guess, 4 units turnover, 3 that are currently available. But the one that we've leased, we hit pro forma. Okay. So it was a 14% gain in a 1 bedroom. Yeah. We've got a little more studio exposure than we like, but that's kind of the commodity product within the building. So that's the expectations. That'll be a little harder to lease over time, but we're pretty happy with it, with the 1 unit we've turned so far. And going forward, what we've done is we've really preserved the optionality to renovate in the future. Gotcha. That's the thesis is mark to market now, get to a yield that we like, but then down the road, we, in 3, 4, 5 years, when the market's really constrained, we can renovate the units and deliver another gain and get to, into the 7s or north on a cap rate basis when hopefully cap rates have compressed, below the called 5.25 they are now. Okay.
So that sounds like, kind of leading to the next question, summary of the first year game plan. Move the rents to market and possibly, when timing permits, or maybe even the seasonality of rent permits, try a few renovations. Are these like blow it out and compete with brand new product renovations, or
you mean like we always do?
I don't know. Usually you guys have done a really amazing job with like period correct renovations on a 100-year-old building. So this building, period correct, leave it as it is.
We've changed our thesis over time. I think because we're in this kind of private wealth space, we have an element of us and of our capital that is focused on pride of ownership. This is less that. This we actually pooled existing capital from our client base, like a syndicator would, but with larger checks. Okay. And it's focused on on really returns, not pride of ownership. And so in this case, I don't think we're going to perfect it, try to compete directly with new product. We'll probably always trail behind. Okay. But I think we'll probably spend more than the typical operator might. We've found that in spending a bit more and spending prudently in areas that residents really care about from a quality standpoint, we get better returns. Okay. And we get higher rent, really, is what it translates to, and better retention.
Retention is rent.
Retention is rent. If you look at our vintage portfolio, I think we have a 3 to 4 year average tenancy when the market is 2 years. Yeah. So that means that we're, and that's at the same time we're keeping up with rents in the market. Yeah. So if we can have, 1 month less of downtime every 2 years, that's huge. That's 8% in gain.
Yeah. I was hoping you'd have that number off the top of your head. We can't ask the traditional questions about what was in place before you got there. It's vacant. Yeah. First year's all construction. Do you have like a rough per unit for 1s, 2s, 3s you think these will rent for?
Yeah, there was like 17 1-bedrooms. Okay. And they had some big dining rooms that we're converting to dens. Okay. So those will all be 1-bedroom plus dens. And, okay. We were, I think, conservative on that with the views and the size of units. We're averaging like 2,400 on those, which I think is reasonable.
And these dens, I'm sure someone can work from.
Yeah, work from home.
You guys going to do washer dryers in the units?
Yeah, every unit's going to have a washer and dryer in it.
Nice. So those 1s, 2,400. You got some 2s.
We've got some 2+ dens and 3 bedrooms. Okay.
Do you know what the 2s? What you think?
I think the 2s are going to be 20. You draw a circle around 2,800, 2,900. Okay. And add a few $100 if it's got a den in it. Yeah. And the 3 bedrooms, I think our best 3 bedrooms that are like 1,400, 1,500 square feet. Wow. 3,400, 3,600 bucks. Wow. So there's some really cool units.
I think I told you this on the phone about, 9-10 years ago. I went to a party in that building in one of those penthouse units. Mm-hmm. They're big. It was like a 30-person gathering.
Several of them have 2 bathrooms in them. And
they're cool.
Just great giant balconies, the whole length of the unit.
Yeah, they're really neat units.
Balcony. We had our architect give us a really cool exterior redesign of the building that were, siding's probably 60% complete. So
nice.
we're going through that right now.
Nice. And so that's the first year plan. How would you say we sit down and we look at all these different scenarios? How do you think you're doing compared to what you planned on doing?
Our construction budget was a little bit higher than what we expected, in part because of some of the things that we found and the costs of moving the panels being a little bit higher than we anticipated. We did end up having a positive surprise in that we found that there's a manager's apartment there that was originally permitted as an apartment that we could bring back to having an apartment. So we have a free apartment that kind of absorbs some of the additional CapEx that we had to put into it.
Nice.
At this point now, we're really looking to finish the last 1 or 2 renovations that we have on our schedule and lease everything up this summer. We're talking now in August, and we hope by the end of September to have everything finished and stabilized.
That's great. I don't think I mentioned at the beginning, but you own and also manage your own properties. For a property like this, are there any things that you guys were able to make more efficient on the expense side of the line or P&L?
I mean, these small apartments buildings require a scattered site approach. You can't bring a full-time manager on site. We have a number of buildings in West Seattle that we manage together with one portfolio manager and one leasing associate.
Okay.
And so we're able to control costs pretty well in that regard.
Yeah.
We have a on-site guy who lives there who we pay to do a little bit of cleaning and yard work, and just generally try to be lean. When you're talking about rents at this level, you can't really afford much more than that.
Yeah. Is this property something you plan to hold for a very long time, position it for resale? What's the long-term plan for it?
Well, we always plan to hold long-term, but as you know, it's also true that everything is always for sale.
Yeah.
So we either we plan to hold it for a long time or we plan to sell to somebody who holds it for a long time. So we're trying to get the right tenants in there. We're really focusing on making sure that we have people that are going to stay and fulfill their commitments under the leases, and that we've put in place the finishings in the building that will allow it to exist for another 60 years.
Yeah. So you've already mentioned a good surprise. We found this manager's office that's now someone's home. We had this plumbing that was detached from a tub for well over a few decades. Any other nuances or lessons learned from this deal?
We experimented a little bit with how to complete the improvements and what's going to get the most value for residents.
Yeah.
It's been kind of interesting to learn. We invested a little bit in some like flourishes, like cool sliding barn doors with attractive black fixtures that people seem to not care about at all. The thing that really made the biggest difference was lighting, which was a relatively low cost investment, but we invested in putting in ceiling mounted lights in all the rooms where they didn't have them before. Before it was just the outlets with the switches, and that I think brought quite a lot of value to people.
Yeah,
I mean, the good one was how quickly the
city's working with you.
Is working with us.
Nice,
right? So our projection on timeline of construction and project has actually moved up.
Nice.
No real surprises beyond that at this point.
You guys are probably crawling all over it for 30 days.
We crawled all over
Yeah.
it. We've got quantified numbers for finishes, so we knew that. We had our plumbers, electricians, elevator companies in there, before we wrote the offer. So we had hard numbers on most of the unknowns. Fire.
Yeah.
We're not to the finish line yet.
Yeah,
so we all know
for
how
sure.
it goes. You don't know.
What's the rough budget, just to give people the order of magnitude of, like, someone might say, oh, that sounds like such a good deal. What's your construction budget?
$3.5 million.
Yeah. So you're 8.5 ish in to a phenomenal building, irreplaceable views. Sounds like a great buy.
It's a great asset.
Great.
We plan to hold it.
Awesome.
I think on the good side, in
Yeah.
fact, I learned this just yesterday. We had 2D remeasure the building.
Oh.
We always go in and have as-builts made because we want to use them both for marketing, but also we want to just understand how things lay out.
Yeah.
It's me particularly, I'm very visual. But what we learned in that, and what we often learn, is that the building was undersized. And so the building grew by, I think it was like 9% on the residential side and 10% on the commercial.
There you go.
And so what that does, it helps us, maybe we can't push more rent because we think about dollars or rents in terms of gross dollars.
Yeah.
But it means that when we're marketing, residents think, oh, I'm leasing 790 square feet instead of 720.
Well, that's
and it differentiates the building.
Yeah.
And again, it's back to the earlier thesis of bigger units.
Yeah.
That's what we're trying to market.
Yeah.
And we also can capture the deck in that too. Now, you can't charge for that, but you can market it and say this unit comes with a 100 square foot deck.
Yeah.
And that's another benefit that you can sort of sell to potential prospects.
Thinking more strategy, future, how has your strategy, I guess, changed since before the pandemic till now, if at all?
I think before the pandemic, we were very focused on finding value through renovation.
Okay.
And maybe it's more accurate to say that that's changed since 2022 and interest rates rising.
Gotcha.
And that's really a circumstance of the marketplace and the kind of deals that are out there. We're finding that we were able to achieve our returns without targeting huge renovations. I mean, we've undertaken what most would call value add, I'd call opportunistic. I mean, taking on development risk to get into the mid-teens for returns, which is just today I can get into the kind of low to mid-teens on a long-term basis without having to take on any of that risk and just mark to mark and renovate modestly and maybe just do common areas like we are for Uptown and get similar returns. So the risk adjusted return feels much better.
So before the pandemic, as prices got crazy in Seattle, I felt like we kind of got chased out. Brokers are calling me, hey, do you want to buy this deal? It's a value add. It's $350 a unit.
Yeah, and you got to add 2 of the units.
Yeah, and you got to add them all, and you got to do, and there, the rubs are going to get you what you need on this, right? So, got to respect the brokers moving deals, and people were buying that, and I, started out buying stuff in core Seattle around $200,000 a door. So I was like, I think I'm going to see what else is out there. And so we went to Renton and bought a couple deals at $150, $160 a door, and then just kind of moved South King and a couple deals in Snohomish that were all, draw a circle around $150,000, $160,000 a unit. And which was half of what stuff was trying to transact for at Seattle. For not half the rent. So
fair.
We just some simple math. I mean, we put a lot more complexity to it than that, but it's just some high level simple math, just kind of gave me that made sense.
I've heard people that keep the math really simple do a lot more deals. It just is what it is.
I mean, our model's very complex.
It's complex, but at the end of the day, it's a simple.
Again, the high level simple thing.
I can buy a unit for half what I could buy that one for, and the rent's not half.
I'm always looking at the intrinsic value of the real estate, and just does it make sense? And there's times where it hasn't made sense, and
So you guys went out of the core, then the pandemic. I mean, suburbs couldn't have got more expensive faster. And now
that worked out great.
We're back in because the core went down a lot faster.
Right.
Well, I think the biggest change from before, during, and after the pandemic is the way that the pendulum has swung on build versus buy. We during the pandemic and before the pandemic, but especially during when interest rates were very low, the way to create value in multifamily was very much to build due to the low cost of capital and the shortage of housing. Many people took advantage of that, built. We're now in a position of oversupply. Interest rates are much higher. And so now we are on the pendulum has swung to the buy portion of the cycle.
And from what I hear from developer clients, there's no profit right now for development. You could just go buy the next door building that's finished for less money than they cost to build it.
That's right. Yeah. And we would much rather be on the buying side of that than the selling side.
Lower risk.
But that doesn't, I think it's important to recognize that our industry is cyclical and that pendulum swings back and forth routinely throughout history and always has and always will. So I think for us, while we are executing now on our acquisition strategy, we are also ready to switch back to a ground up development when the time is right for that.
So moving from there to what advice would you give to an investor today? Like how can they be successful in this market?
I mean, having strong alignment with your equity, I think is really important, and having them understand the marketplace, because in our experience, every deal is made at the margin, and it always feels tight. And I think I can only think of one deal. I felt like at the closing table, I was super excited. Every other one is sort of a dog catching the car. Right? It's like, what do I do now? Crap.
What was that one you were excited about?
It was the Theo Chocolate Factory.
Nice.
3,400 Finney. Yeah. And that one had a ton of hair. It was a URM industrial building with a non-credit tenant and environmental exposure. And it was on a ground lease.
Wow. And you're excited.
But we bought it for $75 a foot when the value should have been $150.
There you go.
And it was like a home run out of the blocks.
Nice. Okay.
I'm no expert, but I feel we're at or near a bottom of some sort at this point. I just look at what stuff's transacting for in the core markets and in all markets and all across the spectrum there. And do I feel it can get much less expensive than that?
Mm-hmm.
I don't see that currently. So I feel pretty good about what we're buying now. And I feel that, it's come down quite a bit.
Yeah.
And so no one can ever time the market perfectly.
No.
If it came down a little more, it's, maybe a blip of a time and, it flattens out and starts moving in the other direction.
Yeah.
I think that where we've been able to see the best opportunities is where there's managerial distress. So there's a lot of buyers out there for buildings that are very straightforward or that have problems that are caused just by financing. And there's also surprisingly a good number of buyers for buildings that have physical problems that need, value add or that kind of work.
Yeah.
Where we've seen a lack of competition is where the residents and the operations have created problems. And that's because it is real work to do that.
Yeah.
And it's very challenging to execute a strategy on a managerial turnaround if you don't have your own property management group to do it.
Totally.
Not only is it hard to find a good third-party property manager, a good third-party manager probably wouldn't even do that work at this point.
They might be the reason that it needs the turnaround.
That's right,
That's
too.
interesting to think about. Like if you're going to go for the operational play, you better be operating your management company.
That's right. And I think that that's true also for like the people that do deep value adds, right? They're doing their own value
construction.
add work, construction work.
Yep.
So I guess this is a strategy we just haven't seen many people take, focusing on that, especially, and that's especially true in the affordable world.
Yeah. Flipping it then, what advice would you give to a seller?
Yeah. Well, it depends. I mean, if you're a seller in this marketplace, it means kind of one of two things. Either you've kind of in a challenging position, most likely, or it's time.
Yeah.
And you've executed your business plan and you're comfortable with the gain today and you want to move for that reason.
Yeah.
And there's, there might be other reasons too, but those tend to be the two major categories of groups that are selling today.
Yeah.
And so for those two groups, it's recognizing that the market's pretty unsettled and I'd be patient to find the right buyer. You might get a lot of low bids and a lot of kind of bottom feeders that are trying to look for deal because there is pain in the marketplace. You know this better than me, but my sense is that there are real buyers out there, groups like us that really will pay and will perform.
Yeah.
But you gotta kind of wait around for enough groups to look at it and eventually that person will come along and find it.
I was trying to share that with an owner this week, actually. A deal that you and I have talked about. Sure. We'll call it Queen Anne. It's close to the golf course in Queen Anne in Inner Bay. Yeah. And I served up an offer that I thought was really actually quite attractive. And after a couple of days of chewing on it, they're like, how do we know this is the best out there? Yeah. And I'm like, because I talked to 20 other people that were all 20% below this. And now this one group is showing up and it's pretty exciting. This is the one to move on. But it's hard to know that until you've seen all these other.
As you know, we're net sellers, and but my experience and looking at it from the other side mirrors exactly what you're talking about. I think the brokerage process right now is pretty challenging. The difference that you bring, I think, is that you bring a huge network of people and buyers because you guys have sold a lot of product and a lot of diverse product. In terms of geography, in terms of size and scale and type. So because of that, I think you guys do a really good job of identifying the right type of buyer. And that's why we've transacted with you, 4 times off market is because
4 off market.
4 off market.
5 total.
Yeah, 5
you had to
total.
compete once.
Yeah, I know. That's right. You made us compete that one time. But you kind of know us and then you knew the seller and you were able to kind of match us together.
Yeah.
And so the result of that is a pretty smooth, seamless transaction. And I'll tell you again, back to my earlier comment, it's, it still felt expensive. It didn't feel like we were getting a deal because we got it off market. Yeah. It just felt like a smoother, simpler process. Yeah. And I don't think that there would have been others that might have paid more. It was simply that, we were the right buyer for that asset.
Yeah, definitely the right buyer.
We sold a couple of our long-term smaller deals that we've had just because it's not efficient for us to, own and manage them anymore. And, those have been some good transactions for us. We've, because it's seems like the market out there has been a market of people who have to sell, not people who want to sell. So I've seen a lot of just stuff that's rough, that needs work, that's, is tough to finance. So when we came out with a couple of those smaller buildings, and I think you guys listed one of them for us, another one I sold off market.
Mm-hmm.
They're, fully renovated, fully, managed, maintained well.
Yeah.
And, we've managed to trade them just to some, traditional buyers who want a clean, asset that they can get financed with a reasonable down payment down.
Yeah. I mean,
So-
what you delivered, like the one you're talking about in West Seattle,
Yeah.
what you delivered to us is a clean product that's operating well. That didn't take much of a discount.
No.
The challenge we have when it's hard to get loans and it's hard to get insurance is you deliver me a building that's in bad shape and the financials suck. It's less the market and more you. So
Exactly.
some advice, if you're going to sell, make sure you got
Clean it all up.
Clean it up a little
Get
bit.
the objections out of it.
Yeah, exactly.
And
Get the
what
objections
I've
out.
noticed is that we've been able to get a pretty decent price for that on
Yeah.
the smaller asset side. And, so we've exchanged that into some deals. We're maybe giving up a little bit, on a $2 or $3 million deal to go into a $5 or a $10 million deal.
Yeah.
You're still coming ahead.
Yeah. And as we always say, if you're selling in a really peaky market, you're also buying in that one.
Yeah.
So if you're selling your good asset where most stuff is distressed, buying distressed, then I think you're getting a big bump up
when
in
we're
value.
exchanging, I think this is the market to do that.
Yeah,
when
for
it's,
sure.
when the market's really inflated, it's kind of like sell and maybe don't reload unless you've got.
I think that many sellers are waiting for interest rates to change, because they think that'll affect the value of their buildings, and I think the heartfelt advice is that's probably right in many cases, because the lower interest rates have a huge impact on the ability to absorb a higher purchase price for the building. Not only do you have less debt service payments because the rates are lower, you also can get much more leverage and need to bring less equity to the table.
Yeah.
So I think as we starting now seeing rates dropping, I think we will see a lot more activity on the selling side. Where we have been successful is where sellers haven't had the opportunity to wait due to something going on in their personal lives.
Yeah. Any fun financing quotes you've gotten since we've seen rates start to teeter and come down a little bit?
Yeah, I mean, we're actually in a really interesting place. As rates have gone up, as the indexes have gone up, the spreads have actually come down quite a bit.
I know. We're like, catch that spread right now.
Right. So if you can lock in financing now with that low spread, you can today lock in the index through a swap product, a very serious decline.
Yeah.
And you'll get very low rates. So we're now looking at construction projects, getting ready for when the cycle turns, and we're getting construction quotes that are in the 200 to 250 basis point spread range, which is just low.
Yeah.
And when you look at the forward curves on the index, the SOFR might be at 3.5 whatever now, but they're pricing it, or 5.5 now, but with the 2-year swap, you can get that down to 3.5. So you're talking about a construction loan that's in the high fives.
Wow.
Which is lower even than the permanent debt
Yeah.
that you're getting through forward contracts
Interesting.
now. So it is a unique time, and I think people that capture the early part of this construction wave will be successful.
How do you expect the election to impact your investment strategy, if at all?
Yeah, it's a big quagmire right now. I think that a lot of people are asking, and ultimately, it's going to come down to a couple things. One is regulation, and the other is the economy. And it remains to be seen exactly what stance the left and the right are going to take. I guess I can predict what the right's going to take from a regulatory standpoint. The left, I don't know how hard they're going to dig in from a national standpoint on rent control and other sort of tenant protections.
Yeah, I've heard a lot.
Yeah, we've heard a lot. That's very different than putting pen to paper and actually writing
different
legislation
than what we've seen locally for a long time.
Totally.
But if there's national backing, it could be a little more shaky for apartment owners.
Yes, and that would be a national challenge that would shake up the entire industry.
Yeah.
And the exact outcome of that, I don't know. Our view has always been that rent control is coming. It's inevitable. It's just a matter of when and in what form. And if it's anything like California and Oregon, it feels like it's palatable and something that we can strategize around or within. If it's anything like New York and San Francisco and some of these other municipalities that have been really, really tough.
Yeah.
That's more difficult, and that'll have a big impact on the marketplace. But I don't think it will be that, and most of the legislation doesn't reflect that.
What's the number one way to safeguard yourself from rent control damaging your return?
Yeah, it's keeping up with rents.
Thank you.
Yeah, no, that's it. And the
That's it.
travesty and what people don't understand around rent control
Yep.
is that if you don't keep up, well, the people that don't keep up are mom and pops.
Yep.
Typically, it's not institutional owners.
Yeah.
That's who rent control is trying to target, is the institutional owners.
Yeah.
but
they're
it fails
with
to do
market.
that.
Yeah.
They're always keeping up with the market, and they've got Yield Star and other mechanisms to do that. It's the small owners that are going to fall behind.
That actually offer naturally occurring affordable housing. They're now calling me to sell to you so you can get it to market so that they don't get killed when rent control passes and affects their value.
I had to quit guessing what the future was going to hold for us.
Yeah.
Because, it's almost like you're on a roller coaster.
Yeah.
And you go into that like dark hole and you don't know which direction it's going to go.
Many times in the last few years.
And it's like, wow, this is fun. And then you're like, woo, we're going down. And it's just like, I don't know. I have no idea anymore.
Yeah.
I quit trying to guess.
Yeah.
You can tell I stick to some very basic metrics just at the high level.
Yeah.
And that works for us.
Okay.
And I'm going to stay on that.
So continued investing, but not trying to guess, need something to happen for you in order for this to work out.
No,
well.
I'm not counting on the, anything specific to, happen other than rates, as we've already started to see.
Yeah.
We're going to see them come down. They're starting to come down.
Yeah.
We got quoted on a deal today. That was pretty.
What was the quote?
It was a small balance Freddie deal. It's actually a bigger deal that we're breaking into a couple loans because we've got multiple parcels. And started at $494. Sorry.
Whoa, that's why I didn't get the reaction from you. I'm like,
we could buy it down to a $454.
So 4.94% interest rate, interest only.
2 point buy down to a $454.
Wow, that's something else.
I
haven't seen that in.
We're locking today.
Yeah.
And I said lock it.
Yeah, smart.
Right. It just works.
Cool.
So it's a 7-year deal, 4 years of IO.
Awesome.
With step down prepay.
Love it.
No yield maintenance.
Cool.
I think that there's a recognition at multiple levels of government, including up to the federal one, that we need more housing, which I think will over time affect our market. The federal government has limited impact over zoning and landlord laws and all that stuff, but I think the implications of that are, we may not be in a housing shortage forever, which means that you have to have assets that are going to be actually quality and be competitive even when there is enough housing around. And also that there could be opportunities in land for long-term holders that may not be easy to build on now, but over time we could get more federal incentives for local governments to increase zoning capacity.
So you think that potentially at a federal level they can make adjustments to make building housing easier? Is that?
Yeah, I think that they can. They don't regulate it directly. It's very much a state and local issue.
Yeah.
But there are tools at their disposal that can help make building easier, and that includes on the financing side where they are major participants.
Yeah,
but also in the funding side where they can influence local government. They can do things like limit, highway funds, jurisdictions that build enough housing. They can provide grants to study ways to remove barriers to housing. And you've seen all the candidates talk about the need to build more housing. And I think at some point that'll trickle through to policy.
Interesting. Thank you so much for joining us today. If you have any questions about anything we talked about, feel free to reach out to our team and we'd be happy to help.